Welcome back to the deep dive. So, whenever we look at these really successful, world-changing companies, our focus tends to land on the stuff we can see.
External metrics.
Exactly. The stock price, a big product launch, the numbers in the annual report. But if you want to understand how these places really work, you have to look deeper. The actual engine, the strategic machine driving it all, that operates almost entirely behind closed doors.
And that's our mission today. Most people hear accounting and, their eyes glaze over. They think it's just this one kind of dull technical job.
It's just counting beans for the tax man.
Right. But we're going inside the ledger to show that it's not one discipline at all. It's actually two completely separate, purpose-driven worlds. Financial accounting, FA, and management accounting, or
Yeah.
MA.
And the difference is huge, right? It's not just about who's reading the report.
Not at all. It's about the fundamental purpose the data is meant to serve.
Okay.
We're going to unpack why one of them has to be super rigid, standardized, like a sports scoreboard where everyone sees the same score and knows the rules.
Okay.
And why the other one has to be flexible, totally custom, and proprietary. More like the private dashboard in a race car's cockpit, giving the driver that real-time competitive edge.
Okay, so let's get into that fundamental divide. Let's start with financial accounting. If they're both using numbers, what is the one non-negotiable goal that FA has to hit?
Its purpose is.
Yeah.
It's rooted entirely in the market's need for trust. Financial accounting exists to enforce standardization and comparability.
Trust. Okay.
Think about the global capital markets. You have investors, lenders, regulators, all trying to allocate trillions of dollars. For that to work efficiently, they have to be able to compare Company A in London to Company B in New York.
Right. Apples to apples.
Exactly. FA provides that reliable, uniform scorecard for everyone on the outside.
So FA creates this common language for outsiders, which makes sense. You couldn't invest money if every company just made up its own rules for measuring sales.
You couldn't.
But that rigidity, that feels like it would crush any kind of internal flexibility, and that's where management accounting comes in.
It does. And it thrives on that flexibility. Management accounting's purpose is to create custom, actionable intelligence. It's not looking outward at all. It's focused entirely inward.
On strategy.
On the ethical and effective execution of strategy within the firm. It doesn't care about standardized external rules. Its only job is to meet the competitive needs of the company. It's the information engine for competitive strategy, full stop.
So if FA is the static public report, MA is the dynamic proprietary tool for operational strategy.
Precisely. It's what gives managers the actual tools to get an edge. MA fuels the core day-to-day operational heartbeat of management. We can really boil it down to this classic cycle: plan, control, and evaluate.
Okay, let's delve into that. If MA is the engine, how does it power the planning part?
So planning is all about using data to look forward. You're setting goals, building budgets. But it's not just guesswork. You're using detailed cost analysis, historical data to forecast things like customer demand or manufacturing costs.
So you're deciding where to put your money.
Exactly. Where to allocate scarce capital. Which factory gets the expansion? Which product line do we cut? Without solid MA data, those are just gut feelings.
Okay, then you move to the control phase. This sounds like where the real-time monitoring happens, checking if the plan is actually working.
That's it. Controlling means tracking actual performance against those estimates you made in the plan. This is where you see tools like variance analysis.
Okay.
You look at the budget versus what you actually spent. If you estimated a material cost of $10 a unit and it's suddenly coming in at $12, MA flags that $2 variance immediately.
Not 6 months later in an annual report.
Right. So management can take action now while the problem is still small.
And then finally, evaluating. This seems tricky. If MA is used for evaluating people or divisions, couldn't that lead to people just gaming the system, setting metrics to make their department look good?
That's a great question, and it's where the rigor of MA methodology is so important. Evaluating is all about assessing performance of people, projects, entire business segments, and you have to make sure the metrics align with the actual strategic purpose.
How do you do that?
Well, you might use something like activity-based costing to find the true cost of a product, not just a simple allocation. For managers, you set up accountability systems like return on investment, which forces them to look at efficiency, not just raw output.
So it's about strategic contribution, not just making a big number.
Exactly.
That brings us to how this actually drives competitive advantage. Let's talk about a real-world example like Walmart. We all know they're logistics geniuses, but how does MA support that?
What's so fascinating about Walmart is the speed and the granularity of their internal data. They use incredibly detailed sales data down to the hour, down to the individual shelf to optimize inventory.
That's proprietary MA data.
Absolutely. They know exactly how much shelf space to give a product in, say, Florida versus Alaska, in July versus December.
So they're not just selling products, they're feeding information about demand right back into their MA systems.
Yes, and that efficiency, knowing exactly when to restock, which placement triggers an impulse buy it, means they have way lower carrying cost and better inventory turnover. That's a competitive weapon forged by their MA intelligence.
Okay, now let's switch to a totally different world. Construction. Razor-thin margins. They're not tracking shelf inventory, they're tracking costs out in the field.
But the principle is identical. Their custom MA cost tracking allows them to bid on jobs accurately and, profitably. They have to track labor hours, material waste, subcontractor costs against their estimates in real time.
So if their internal MA is sharper than a rival's,
They can submit a bid that's profitable but still wins the job, while the competition either bids too high and loses or bids too low and loses money. That precision is what keeps them in business.
this is where it gets really interesting because for management accounting to become this powerful strategic tool, something had to happen. There was this revolutionary moment, the invention of return on investment, or ROI.
This is truly foundational. I mean, before ROI, trying to manage a massive company was a complete nightmare. You look at DuPont in the early 20th century.
Right, they were vertically integrated.
Totally. They owned the suppliers, the chemical plants, the sales operations. And the executive team, led by Donaldson Brown, had this massive accounting problem.
They look at two divisions. Say, a chemical plant made $500,000 in profit.
Mm-hmm.
And the sales division also made $500,000. So the simple question was, are they equally successful?
And based on profit alone, the answer was yes. But Brown realized that was completely misleading. That plant might have $50 million tied up in equipment to make that profit.
While the sales division only needed $5 million in trucks and capital.
Exactly. They were only looking at the numerator, the profit, and completely ignoring the denominator, the investment it took to get there.
A huge difference.
A huge flaw. And that's what Brown solved. He introduced the DuPont ROI formula. ROI equals profit divided by investment.
Or more technically, net operating income over average operating assets.
Right. And this simple formula instantly did two critical things.
First, it integrated cost management with asset management.
Yes. Suddenly, a division wasn't just judged on the money it made, but on how efficiently it used every single asset it was given, from machines and inventory to cash. If you made great profit but had inventory sitting around forever, your ROI would tank.
Let me stop you there. When they introduced this, was there pushback? Did managers hate being judged on their capital efficiency all of a sudden?
Oh, there had to be. Before ROI, a factory manager was just incentivized to maximize output. That's it.
Right.
Now, suddenly, they were being measured on managing their entire asset base. It forced a massive behavioral change. They had to think like owners, finding ways to reduce idle equipment, speed up collections.
And the second thing it did was give them that single, objective, comparable metric they were looking for.
It did. Now they had a clean percentage, 5% versus 10%, and they could apply that across mining, shipping, manufacturing, anything. It became their strategic control system, guiding where they reinvested their capital. It really transformed MA from just bookkeeping into the strategic discipline we know today.
That sets up the flip side perfectly. If MA thrives on that flexibility, financial accounting, as we said, thrives on the constraint of uniformity. Why does it have to be so rigid?
Because of the audience.
Right.
Outsiders, investors, and creditors don't have that internal view. For them to trust the system, to make big decisions like, should I invest in this company? Right. They need to know everyone is playing by the same rules.
They need that apples-to-apples comparison.
They demand it, which is why the key characteristics of FA flow from that need. We're talking about summary data, not granular operational detail.
So total annual sales, not sales per shelf per hour.
Exactly. It's highly aggregated. And crucially, it has to follow standardized rules. That's GAAP in the U.S. or IFRS internationally. This makes sure the data is a neutral historical record and unbiased scorecard.
And these rules are backed by a pretty serious governance structure.
Absolutely. In the U.S., the SEC, the Securities and Exchange Commission, has the ultimate legal authority. But the SEC delegates the job of actually writing the rules, GAAP, to a private, independent body.
That's the FASB.
The Financial Accounting Standards Board, yes. It's a critical relationship where a private group sets the technical standards that the government then legally enforces.
And for companies in, what, over 140 other countries?
They often follow IFRS International Financial Reporting Standards set by the IASB in London. These structures exist purely to create that level playing field, even though, complying with these rules is incredibly complex and expensive for companies.
So that cost of compliance is the price of admission for market trust.
It is.
So to go back to our analogy, FA is the required public post-race report, standardized for all the fans and bettors. MA is the custom proprietary toolkit the driver uses to actually win the race.
That distinction is the heart of it. But there's a critical overarching point here we have to make. Because MA is the actual hand on the operational lever, the discipline that executes strategy. It carries an enormous broader responsibility. It's not a neutral technical function. It's a potent, powerful decision-making tool.
And this is where we get into the ethical weight of it all. The decisions that MA data informs, they impact people far beyond the company's owners.
Way beyond. Think about the plan and evaluate cycles we talked about. When MA data shows that moving a factory overseas will cut labor costs by 30%, that decision, which is justified by internal cost data, has a massive impact on the employees who lose their jobs and on the economic health of that entire community.
Or, say, environmental impact. If an MA system is optimized only for cost control, a manager might be rewarded for choosing a cheaper but dirtier waste disposal method.
Because the internal MA metrics only reward cost reduction. This means business professionals using this data have to understand it has real human consequences. They have to uphold the ethics of good business fairness, objectivity, responsibility.
They have to be willing to present the accurate data, even when it's ugly.
Even when it exposes a costly mistake or forces an unfavorable choice. Yes.
So it's the difference between using that race car dashboard just to win versus using it to make sure you don't endanger the public while you're racing. We've defined this dual purpose. FA provides standardization for capital markets. MA provides custom intelligence for competitive strategy.
And MA, because it guides the operational execution, is the one that directly controls the business's moment-to-moment impact on the world. Far more directly than those standardized FA reports.
Which brings up a really important question for you, the listener. If you understand that management accounting is the direct operational lever, the thing that determines how people are treated, how assets are used, how communities are impacted, how does that change the way you view the data driving strategic decisions? Is that custom toolkit being used just for competitive efficiency or for a broader responsibility? Something to think about.